Hello guys, and welcome back to the fifth lesson of the Zero to Hero course. And in this lesson we're going to be talking about bias. So let's get right into it. What is bias? You heard me talk a lot about bias, and this is the actual definition. Bias is the direction in which the market is moving towards. As mentioned earlier, price only moves for one or two reasons: to make a run on the liquidity, or to fill an inefficiency. And bias is gonna help you understand and identify where the market is drawing to. So if you have a bullish bias, you can expect price to make a run on the buy side liquidity because we are bullish. Meaning, where is the clear area that price wants to reach? And that's what drawing means. When we say the market is drawing, where is the market reaching for? What level or what area is the market trying to go to? So is price drawing to take out the sell side liquidity, or is price drawing to fill a bullish inefficiency? So that's why it's very important to be highlighting the key levels of liquidity and inefficiencies in the market, so you can better understand where the market is drawing to. And there's two types of liquidity. First, we have the high resistance liquidity, and this sounds exactly like how it is, and that means it's points of liquidity where there is quote unquote resistance, making it more difficult for price to reach that point. And the resistance is gonna come in the form of swing highs or swing lows, depending whether if you're bullish or bearish. So as you can see in this example here to the left, what we have here is here would be our high resistance sell side liquidity, because there's a swing low here, a swing low here, swing low here, swing low here, swing low here. And look at the way that the market is moving: high, higher high, low, higher low, higher low, higher high, higher low, higher high, higher low. So when we see a higher high, higher low formation, that means that the market, that the current market structure is what? It's not bearish, is it? Because we're getting higher highs. It's a bullish market structure. And the opposite here for this downtrend, because we see here we got a high, lower high, low, lower low, lower low, high, lower high, lower low, lower high. So this up here, this swing point right here, all the way at the top, is our high resistance buy side liquidity. And the importance of understanding the difference between high resistance and low resistance is that high resistance liquidity, and for price to take out the high resistance, what price would need to do is trade below this point first before reaching this point, then below this point before reaching this point, and below that point before trading below this point to reach this point. So price has to go all the way down here. It has to retrace back up a bit, back down, trace up, back down, retrace up, back down, to take out this key of high resistance liquidity. Same thing happening here. If you want price to take out the swing high here, it's not gonna happen like this. That's very, very, very rarely that's gonna happen. So what we would expect price to do if it wants to go all the way up here, first we see a displacement up here, then a retracement lower, then a displacement higher, retracement lower, displacement higher, retracement lower, until finally taking out this high resistance buy side liquidity. And now on the other hand, we have low resistance liquidity. And low resistance liquidity sounds exactly like how it is. Same thing. It's points of liquidity where there is low resistance, making it easy for price to reach that point. And the low resistance is just gonna be that there's nothing protecting it. There's no swing points. It's just there for market to take. So look at this example: swing high here, and the market is bullish. What would happen? We'll see a swing low lower, market would trade higher, taking out the low resistance buy side liquidity over here, because price traded higher with a displacement. Same thing here. We get the market is bearish because of this displacement. Price consolidates for a little bit, makes sell stops here because of the equal lows. So that's our low resistance sell side liquidity. We can expect that once price comes up to fill this gap, we can expect the next target to be here. And so why it's so important to understand high resistance versus low resistance because it gives you an idea of where the next target is. So obviously you want to be in line with the bias. You don't want to be the guy who let's say price is going higher and you're thinking that price is going to reverse right now just because you feel it. Obviously that's not how this works. There has to be a reason behind why you feel it. There has to be logic behind why the market is doing what it's doing. So obviously it's more expected that price is going to be drawn towards points of low resistance liquidity, because it just makes more sense for price to reach those levels. And let me go on the chart and actually put into action my words. So here we have DXY, right? And DXY is the dollar index. So meaning this is not a pair against anything. This is not US dollar against a random currency. This is just the price of the dollar on its own. That's what the dollar index stands for. So when we see the dollar index going higher, what that means is everything with USD in the beginning is going higher, and everything with USD at the back is going lower. And what I mean by this is something called correlation in the marketplace. So DXY is equal to dollar on its own. Okay, so when DXY is going down, that means all US pairs should be going down, because there's correlation with it. And the opposite, if it's, oh wait, let me just add it here. So DXY is going down means all US pairs, let me just make it, all US pairs should be going down, and all foreign pairs should be trading higher. So that's why it's very important to identify the bias on the dollar index before going into your pairs and identifying the bias there, because typically if the bias on the dollar is bullish and you check a pair like USD GPY, it'll also be looking bullish and have similar market structure to the DXY. And same and opposite for Euro USD, because as you can see, USD is the currency against Euro. So what that would mean is that Euro is getting stronger because the dollar is getting weaker. The dollar in Forex is really the big dog. It's really the big player. So DXY is going up. And what would that mean? All US pairs should be following and going up. And foreign pairs should be going lower. So let me just show you exactly what I mean really quick. So look at this. 28 December till 17 Jan, yeah? 28 December till 17 Jan. Let's go to Euro. 28 December till 17 Jan, price went lower, and here price went higher. Let's go USD JPY. Where it is? What was it? I forgot this, man. Yeah, 28 December till 17 Jan. USD JPY. Look at this. 28 December is here till 17 Jan, which is over here. So you can see there's correlation in the marketplace. Okay. And then let's go back to DXY. And let me show you an example of what is high resistance sell side liquidity. Quickly look at the market right now and tell me, do you see any points of sell side liquidity? Just quickly in your head just point it out and focus primarily on this chunk of price right here. Mark out in your head where are the key points of sell side liquidity. I'll give you a minute. Okay, I think that's enough time. So first we have these lows here, and just to clarify, I'm on the daily time frame, meaning each candlestick here is one whole day, and you always start to figure out your bias using the daily time frame. You don't just start on the 1 hour and go up No, start on the daily and you go down. It's called top down, and I'm gonna speak more about it in a couple of minutes. So this here is our sell side liquidity. Let me just make it green so we can identify it. And this here is our high resistance sell side liquidity. Sell side liquidity. And the reason it's high resistance is because look at all of the other sell side liquidities made protecting this level. First, we have this swing low, then this swing low, then we have these equal lows, then here we have another swing, same swing here, and swing here, right? So all of these points are also our sell side liquidity. So all of these points here make this high resistance sell side liquidity. And let's see what that means, because obviously, first let's see why the market came down to this level. Look, what do we have to this side here? We have sell side liquidity, right? So price came down, traded the sell side liquidity, got those traders trapped in short before sending price higher. And where would be our first objective? The first thing we'd like to see is price to trade back up to fill all of this inefficiency, because as you remember, we learned about gaps last lesson. And look here, the low of the first candle and the high of the third candle make a gap. Same here, low of this candle and high of this candle make a gap. So there's a bunch of gaps here. This means that the market is very inefficient when it was taking price lower, because it did not give price a chance to trade higher. And what does that mean is price is going to eventually trade higher. So once we seen that price took out this sell side liquidity over here to the left, our next target in our head is to see price reach up to here and to fill these gaps. And when do we expect price to reach? Once we see a swing low on the daily. I'd say it's a fair time to expect price to go higher. Doesn't mean you see a swing low and you go long. It means you see a swing low and you wait for a reason to go long. That's what that means. So we can expect price to trade higher onto where? Until this area first. So price did exactly that. Price went up, retraced down, filled this gap, traded higher, taking out this high. And what's so special about this high is that this high is our low resistance buy side liquidity. Yeah, that's better. And the reason that this is our low resistance buy side liquidity is because we are expecting price to trade higher. So when we see a swing high get made, all that's telling us is that price might retrace back down to fill an inefficiency or to take some sort of sell side liquidity. And price did that exactly. Price came down, just had a strong wick down, can't lie, and to fill this inefficiency here. So now this whole displacement higher is no longer inefficient. It's been efficient. It's been it's been corrected. So the next target after that price has been corrected would be to go trade higher into the slow resistance buy side liquidity. Because price only goes for one or two reasons: to take out liquidity or to fill an imbalance, to fill an inefficiency in the market. So here price took out the sell side. So what's the next step? To price to go back up, to retrace, to fill this inefficiency, right? But within price filling this inefficiency, there was another one made. So price first went up, gave us that swing high, giving us that buy stops over there. Then price would come down to fill this inefficiency, and that might trap some traders going short because they've seen all of this and thinking, yeah, let's go short. But we know that price doesn't just want to go up here. It has to go at least up to here, to these, maybe to this order block level. So price did exactly that. Went here, had some orders trapped short, and then came down, filled the inefficiency, traded higher, taking out the slow resistance buy side liquidity. And what we see here is price, look at this wick. Price traded to this order blocks level. These three candles are considered our order blocks because it was the last bullish candles before this strong displacement lower. And what that tells us is when price reaches that level, it doesn't mean we automatically switch bearish because we don't know yet. We're still bullish. We have to see something which makes it bearish for us, correct? So price went here, traded lower, maybe to fill an inefficiency in the lower marketplace, or simply just to trade lower to take out stops. Because obviously below these lows, there are gonna be short-term sell-side liquidity, but on the smaller time frame. And then where is the next logical point for price to trade up to? To take out this swing high over here, because this swing high is also low resistance buy side liquidity. And the reason it's low resistance buy side liquidity is, this is very key what I'm about to say, and I need you to implement in your mind that everything I'm teaching you has to be in line with the bias. Because if your bias is really wrong, let's say market is bullish and you think it's bearish, none of this is gonna work for you. Like, the key concepts are still there. Like, what's resistance? I mean, what's liquidity, order blocks, and all of that. That's all still gonna work for you. But if you think market's bearish and price came to this order block level thinking, yeah, I'm gonna go short now and expect price to trade all the way down here, but that didn't happen. So don't think that order blocks don't work. The reason it didn't happen is because price is biased, is bullish, it wants to go higher. So once price came here, made this swing high, creating our buy side liquidity, price would retrace back down. And where is the next logical option? Higher, above this low resistance buy side liquidity. And what do we also see here? Price took out these equal highs here, so it took out the low resistance and this liquidity here. And also, if you look here, before price traded higher, taking this out and this out, there was a wick, a lower here, taking out this low and this low. So it's also taking out short-term sell side liquidity. That's what the market does. When the market is bullish, it's gonna attack short-term sell side liquidity to trap some traders and get the money into the marketplace before trading higher, trying to reach what levels? Low resistance buy side liquidity. And so price went back up, took this out here, took these liquidity with this strong displacement, and before where did it go? Actually, it took out this, it took out these bodies of the candle. As I mentioned earlier, the bodies have more weight than the wicks because the chunk of the volume of the candle is here, meaning in most of the day price traded in this range between these levels in the bodies, not in the wicks. Price might have just went up for a bit and before coming back down, so the majority of trading during that day happened inside the bodies of the candle, not in the wicks, and it's very important. So price wicked higher, wicked above these bodies, taking out a large pool of buy side liquidity before price trades back down, taking out what do we see here below all of the swing highs and the equal lows? You guessed it, sell side liquidity. And that's what market's doing. Market's gonna go down, take out the short-term sell side liquidity, but that does not mean we were bearish. If we were bearish, if the market switched bearish, this move is not enough. What you would want to see is a move like this, market, you know, like when you see a displacement, you want to look at the chart and be like, damn, the market really did move like that right now. That's what you want to see. So price took out the sell side, and you guessed it, next target would be what? The low resistance buy side liquidity. Same thing here. Oops. How did the same mistake twice? That's crazy. Low resistance buy side liquidity. So once it took out the short-term sell side, where's the next ideal position? Because our market bias is still in fact bullish, and the reason it's still bullish is because look, low, high, right? Higher low, higher high, higher low, higher high. The same thing, the market is in a bullish market structure. The market is bullish, and it's bullish until we see something make it not bullish. That's how this works. So price was to go up to this low resistance buy side liquidity to attack it, that's its target. And when price was taking that low resistance buy side liquidity, what happens here? I hope you guys can see it before I say it. But let me just change this to black. This is a fair value gap. It's a bullish fair value gap. So when we see price trade down into it, that means it's our bullish area of interest, meaning that we can expect price to trade higher. What will price be targeting? You guessed it, the low resistance buy side liquidity. Same thing happening over and over. The market's an algorithm. It follows a set of rules. That's what it does. Again, same thing. Price was to come down, retrace. Maybe some gaps here, some inefficiencies on the smaller time frame before trading higher, taking out this short term, this low resistance buy side liquidity. So now you learned about the low resistance buy side liquidity and high resistance sell side. Now we just go a bit to the right of the chart, and now we'll see the difference the opposite way. We'll see high resistance buy side and low resistance sell side. So let me remove this really quickly. So once we see price trade here and it goes a bit lower, and I can guarantee you there's a reason that price went lower. It didn't just go lower for the fun of it. Let's drag this out and let's actually see what's to the left. Let's see. Okay, look, price traded till here, and what did that take out on the way? This swing high and these equal highs here. So price took those out. That's what price did. We don't need this, I'm not gonna lie. We just keep the highest point that price took. Price went up, taking out this buy side liquidity, this key swing high. Price came, took it out. Then once we seen price take it out, what did we see? We seen price trade lower to take out this swing low, and that swing low, what's under it is sell stops. We seen price trade lower with not really much of a displacement, so we can't say that the market is bearish just yet. But all we know is that price came and took down the sell side liquidity, and price retraced back up, then coming down lower, taking out the newest sell side liquidity, which was made by this swing low. And price traded back up here, taking out these equal highs and the swing high, before market trading lower. So we can consider this our area of accumulation. As you remember, after market expands, there's gonna be some sort of accumulation where that's the market getting in orders going both long and short. So this would be our area of accumulation, and that's where the markets are getting their traders. As I mentioned, there's gonna be typically when the market bias is bearish, what we're gonna see in the consolidation is that price will take down the sell side first, right here, before going higher, taking out this buy side right here. And you can see, as I mentioned, the majority of the volume is in the bodies of the candles, not in the wicks. So we see here our buy stops, right? Price took out the sell stops here for wicking higher, trading above the bodies of this swing high, which is also where our buy side liquidity is, before market has a strong displacement lower. This is a displacement because it's a strong candle taking out a swing low, a key swing low. This is what this is. Then we can expect price to retrace before going lower. And look at how price retraced. What do we see here? I hope you guys are seeing this now. What we have is our first candle's wick low, and then the third candle's wick high. So what's this? An area of inefficiency. This is a bearish fair value gap after we've seen a bearish displacement giving us a bearish shift in market structure, and we see a bearish gap. 3 bearish things happening all at the same time. So what can that tell you? And all of this is happening on the daily time frame. This holds a lot of weight. So what you see on the daily is going to transpond into the lower time frames, and it's going to make sense. So if you're seeing all of this on the daily, we can expect price to be bearish pretty soon. Okay, so price came, took out the sell side, giving us the displacement, created this gap on the way. Price traded higher to fill the gap before giving us another displacement. So what's happening here is price is creating the sell side liquidity with this swing low, meaning there are gonna be orders below this low. There are gonna be liquidity below this low. So price is gonna trade back up to fill the gap before giving us our bearish displacement, another bearish displacement, lower. So what does this swing high become? You guessed it, high resistance. High resistance, buy side liquidity. And over here would be our low resistance, sell side liquidity. Price came to fill the gap, fill the inefficiencies before trading lower, targeting our low resistance, sell side liquidity. And over here, what do we have? Equal lows on the daily, and the market bias is bearish in this example. So we also have lower resistance, sell side liquidity. And just look here how bearish the market really is. The price didn't even want to retrace higher up to here. Price just wanted to keep going lower. I made this swing high over here, and what is that? Our high resistance, buy side liquidity. Then price came to fill this gap here. It's a small gap. I don't know if you can see it, but it's a small gap right here. This point and this point creates a gap, but there's probably gaps here in the smaller time frames. Price went to trade up to fill the gaps before trading lower. Then once price traded lower up below this point, because this point is also our low resistance, sell side liquidity. Oops, what's going on? Price traded lower before trading higher, and price actually took out this swing point here. But this swing point is just a run on the buy side liquidity, and that's part of the game. You're gonna have to identify which ones are likely to get ran through and which ones aren't. Because look, here there's some inefficiencies here. Price will to trade up, take out this liquidity before a strong bearish move down, attacking what point, what key area? You guessed it, this low resistance, sell side liquidity. But price didn't take out this high resistance, buy side liquidity, so our market bias is still bearish. And then price continues to deliver lower because of this displacement here. Then we had swing low, which is our low resistance sell side. Price went up a bit before going lower, creating this swing low here. And currently price traded back up is in this inefficiency. That's the current price action of dollar. So let me actually try and put this into words for you guys. When the market bias is bullish, each major swing low, and a major swing low is a swing low on a time frame which holds some weight, so 4 hourly or daily, even hourly you can consider it. But I wouldn't say a swing low on a 15 minute is considered high resistance, because anything can happen in the 15 minutes. It can take out the key low in the 15 minutes, but on the 4 hourly it's barely a move. It could be just a wick. So that's why it's very important to understand the time frames. So when the market bias is bullish, each major swing low is acting why is my spelling so bad? Acting as a level of resistance, meaning the swing lows below each swing have some sort of protection. And what we would want to see when the market is bullish is each major swing low, does this sometimes and it's very weird. Each major swing low to be higher than the previous swing low, and each retracement is price just filling an inefficiency or to take out the the short-term sell side liquidity. And we would expect that with each bullish expansion, price is taking out the low resistance buy side liquidity, coming in the form of swing highs and equal highs. So this is what we would want to see when the market bias is bullish and market is currently in an uptrend. This is exactly what we would want to see. So the next thing is when the market bias is bearish, each major swing high is acting as a level of resistance, protecting the swing highs which are higher. Alright. And what we'd want to see when the market is bearish to see that each major swing high is lower than the previous swing high, and each retracement is price either filling a bearish inefficiency or price is taking out short-term buy side liquidity. And we'd expect with each bearish expansion, price would be taking out the low resistance sell side liquidity, coming in the form of swing lows and equal lows. And this is what we would want to see. So let me explain high resistance and low resistance just to make sure we got it using these figures. Okay, so here we have a bullish uptrend, right? So let's mark out this key level. So imagine none of this happened here to the right yet, just this swing high and this swing low and this one, of course. So price initially traded higher here, creating liquidity, right? Creating our buy side liquidity. Just each red line is buy stops, so I don't have to write it down each time. And lower here is our sell side liquidity. So our underlying market bias before we've seen all of this is that market is bullish. Maybe this is what price did. Price came down from here, taking out key level of sell side liquidity over here. Price came, took that out, and now we'd expect price to trade higher. So our underlyingness is bullish. So we'd see a retracement, we'd see this here, this expansion here, to fill maybe some gaps or to go to an order block before price retrace back down. But it's very important to notice that when price retraced back down, it did not trade below this low, it stayed here. It stayed between this swing low and this swing high. That's where price stayed. So price were to come down here, and knowing that the underlying market bias is bullish, our next assumption would be that price trades to where? Till this point here, till this low resistance buy side liquidity. And the only reason we consider it low resistance is because it's liquidity in line with our bias. Meaning if we were still bearish and we'd expect price to come back here and go lower, we wouldn't expect price to go higher because we're bearish, right? So we would expect this. If you're bearish, this would be high resistance buy side liquidity, because we'd expect price to continue trading lower. But in this case, it's not. Our underlying bias is bullish. So price would have come here, taken out this buy side liquidity, creating what? More buy side liquidity at this point here, and sell side liquidity over here. So now if you noticed, there are three types of sell side liquidity which have been untouched. This sell side liquidity is just brand new, hasn't been touched yet. This one here, price didn't trade below it, so it's still intact, and price never traded below this, so it's still intact. So that's making this over here, this swing high right here, high resistance. Because what we would need to see is, to price to take this out, is instead of price stopping here and going higher, we want to see price trade below this right here before trading higher, maybe into a breaker block, before taking out this high resistance liquidity. And that's the difference between high resistance and sell side when the market is bullish. And same thing's happening here. Price came back down, stay to this breaker, for trading higher, targeting this low resistance buy side liquidity. And that's if the market bias is bullish. So let's see when it's bearish how it would look like. This initial move down, retracement higher, initial down, higher, down, higher, down, higher. Okay, and this is our market structure. So imagine price is moving like this, and what do we see here? Let's make the same assumption that when price was trading higher like this, and price was coming down initially, yeah, let's say like this, price took out some sort of liquidity to the left of the chart by this initial move. So now we begin to think that it might be going a bit down, but we're not totally sure yet. We're just being patient and waiting to see what's happening, and I'm gonna tell you when we're sure. So price will have that move lower, making a swing point here, and this swing point would be our sell side liquidity, and this swing high would be our buy side liquidity, so our buy stops. Price would go up, retrace, making the buy stop, making the sell stops. And our underlying marketness, our underlying bias of the market is that we're bearish. So the next logical area would be for price to trade below this right here. So, and that's our low resistance liquidity. Our low resistance sell side liquidity, to be specific. Price would have a retracement, create a swing high at the order block level, or the breaker block, excuse me. We have our buy stops. So these buy stops are protecting this initial buy stop here, this initial swing high. So this swing high is our high resistance liquidity point, and that's the same reason. Because if we want to see price take this, instead of price, like I say, price went down here, taking out this low resistance sell side, instead of price going back up and going down, we want to see price trade up like this to take out this buy side liquidity, and after price took that out, maybe retraces back to the breaker and seeing another strong move, taking this out and retraces. And once price retraces back here, we'll know for certain that price is attacking this point now. And that's high resistance liquidity, both with the buy side and sell side, and both bullish and bearish market structure. So let's go back to the slides, see what we have next. So we have a very important one right here, and I'm gonna start it in a second. Let's see right here. Now we're gonna be talking about the importance of time frame selection. So as I mentioned earlier, higher time frame holds more weight, and what I mean by holds more weight is it's more important, we can say. So if we see a bullish order block on a daily time frame, that bullish order block, if the bias is bearish, if the bias is bullish and we see a bullish order block on the daily time frame, that bullish order block is more likely than not to actually play out, to actually be right. But that doesn't mean you just use the daily time frame. Well, because that wouldn't really make much sense. There's all of these time frames there for a reason. And the reason is for us to break down the price, to break down the actual price action that's happening in the market, and gain a better understanding of what the market is going to do next. Next point is, each time frame has their own use and need to be used together to gain a grasp on the directional bias. Meaning no one time frame is better than the other. Some sure can be more important, but doesn't mean it's better. And different types of trading styles will highlight different time frames. And in this course, you're getting taught as an intraday trader. And what that means is that you're getting taught as a day-to-day trader. Meaning you're checking the charts every single day, but you are not taking a trade every day. You are taking a trade only when it's necessary for you to take a trade. And daily is used to see where price is drawing to. And I mentioned this before. Drawing to is basically where you think price is reaching to, where it's gonna go to next. Where's the next logical point that price is reaching to? That's what drawing means. And 4 hour is used to see the short-term liquidity points. Hourly is used to find the shift in market structure, and 15 and 5 minute is used to find entry. And this doesn't just mean you only use hourly to find shift in market structure, or use 4 hour to see short-term liquidity points. Right? You can use all of these hours with all of your tools, with everything that you have, and to see what you know, and to understand what the market's doing. Next, something called a top-down analysis, and I briefly mentioned this earlier in the video. And what a top-down analysis is analyzing the chart starting from a high time frame, like the daily, and dropping to lower time frames gradually to better grasp what the market is going to do. So first, start at the daily, drop to the 4 hour, then the 1 hour. And the reason to start in a higher time frame is because each candle takes longer to form. So on the daily, each candle is one whole day of data. So that data took a long time to get set in stone and have the high here, the close here, the opening there. It took a whole day for price to reach that level. That's why it has more weight. So let's go into the charts, and actually I'm gonna show you how to do top-down analysis. I hope you guys can't wait for this top-down analysis, because I can't, let me tell you that. Let me clear all of this noise real quick. And same thing here. We're gonna analyze the same bullishness of DXY, but starting from the daily. So same thing, we'll do the same thing as before. What we see here in the daily, price took out this daily liquidity. Oh, that's sell stops. Sorry. Sell stops. Took out this daily liquidity. Retraced back up to this inefficiency. Retraced, going back up. So what we see on the daily is after this swing high was broken, we see that the market is truly in fact bullish. And to what point? Our first point would be this swing high. It's our first target where we'd expect price to reach towards. And the next would be this swing high. And finally, we'll say this high, the candle high. So we've seen price retrace back down into this level here. And here you just see price going down and trading back up. But if we drop down into the smaller time frame, we'll see that this here actually has a reason. There was a reason that price traded lower. A very specific reason actually. As you can see, price creates what up here? Let me just delete this because now we know where it is. Price created what up here? I hope you guys got it by now. Low resistance buy side liquidity because the market is bullish. So over here we have liquidity. We have our sell side liquidity. So on the 4 hour, you can clearly see why price went lower before trading higher. Price went lower here to take out these sell stops before trading higher. And we wouldn't have known this if we didn't see it on the daily time frame. But we seen it on the 4 hourly. We seen these equal lows, the swing low also. So there's liquidity and price took it out. And we seen that because we dropped down to the 4 hour. Then we seen price trade higher. And what do we see here on the 4 hour? Gaps. We seen a displacement above the swing high. And that's confirming that our bullish play is still intact. So we have another target of here. And for our initial target of this swing high here. So price would come down here to fill this gap right here. As you can see, we have the high of the first candle, the low of the third candle, making a gap here on the 4 hour before price decided to continue trading to a higher point in price. Just make it black. Price came, filled the gaps, then quickly shot back up. And where did it go back to? Look at this, look at this, look at this. This is what I mean by understanding bias in your order blocks and any of these concepts, order blocks, breaker blocks, or gaps. Same thing here, right? We see there's bearish gap here, bearish gap here. Price came up, filled the top gap just a little, and filled this gap all the way, this one here. But when price went up here, where did it wick to exactly? To the body of this bearish order block. So what do we expect to see when price is at the order block, which is against our bias? We don't expect price to reverse completely. We expect price to retrace into another key area, key point in the market. And our nearest key point, as you can look here, same thing happening almost exactly as well. Price came to this, to this here bullish order block, because as you can see, these two candles were the two last down close candles before a bullish move higher. So this would be considered our bullish order block, and we'll know that that bullish order block is in play if our market bias is correct. And we know our market bias is correct because of this displacement here above this swing high and above this swing high to the left. So that's how we know that our bias is still in play, because it's still producing higher highs and higher lows. So we are still bullish. So price will come back down, will retrace from hitting this bearish order block into this bullish order block now before price trades higher, taking this out. And what is this? Low resistance buy side liquidity. Price will trade higher. See on the 4 hour, gap here, gap here. We'll see, just mark it out. We'll have this here and this here, same a gap as well, same thing happening over and over and over and over and over and over again. Price will come down, retrace, and where did the wick go? This is crazy. This is insane. Look, and this doesn't happen just at one time. This happens all the time. The market is structured to go to certain levels. The market doesn't just go where it feels like it's gonna go. The market goes specifically to a specific point in price. So we can see here, look, another gap, right? Because of the wick high of the first candle and the wick low of the third candle, creating us a bullish fair value gap. Price would wick down, fill this gap. So now this whole bullish displacement has been rebalanced. There is no more inefficiencies. So now there is no reason for price to stay at this point here. And it's gonna go to our next target, which is Dun, 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 dun. Our low resistance, buy side liquidity right here. Price goes up, comes here to the gap, fills it, trades higher. But let's say we go into the 1 hour time frame. What can we see more? Because each time frame, when you go smaller and smaller, is more valuable points of data. That's what we're looking at. But if you go too small, you can go a bit crazy. You have to be honest. If you're going down to the 1 minute, and you're analyzing all of the trends there, you might lose your mind. So we should not do that. I'd say the lowest time frame you should go in to find entry is like the 5 minute. That's what I would personally say. Or 3 minute, no lower than 3 minute, if you're really trying to find that specific entry point. But typically, if you find yourself going lower and lower in price and you don't find anything there, but you think there is, so you go 15, you go from daily to 4 hour to 1 hour and you're unsure, then you go 15 minutes, you're still a bit unsure, and you go 5 minutes and you find something there, that thing is typically wrong. Let's say you find some bullishness in the 5 minutes, right? Don't take that bullish trade. Don't take that trade going long, because your 15 minute, you're confused about it. Your hourly, you're confused about it. Your 4 hour, you're confused, and your daily, you're confused. You need to make sure that if your daily is bullish, you go in the 4 hour and you'll still see that the market is still bullish there. You go down to the hour, it's still bullish. It all has to like come in together and work together before you can actually take a trade long. That's very important. So let's look at the next thing in price on the hourly. You see this price action right here. We see price trade higher to this point here, taking out, let's see which key level. Go a bit back, taking out these highs here. And what we see is when price took those key highs, we see sell stops over here, right? Short-term sell stops because it's on the hourly. And what we see below these sell stops are an inefficient market, because there are gaps which have not been filled yet. So you see gap here and the gap here as well. So let me just draw that out. So price would come back down to fill these gaps, and look where price stopped at before trading higher. It stopped at the bullish order block, and this bullish order block is in play because the market bias is bullish. So that's why we'd expect this bullish order block to actually work and trade higher. And where will it trade higher to? To this point right here, to this swing high. And this swing high is what? For the last time, this swing high is our low resistance, buy side liquidity. So that's why the market does what it does, and this is how you can identify bias. And everything I'm saying here is flipped to the other side. And let me actually show you an example of top-down analysis when the market is bearish, so you can understand. Over here. So imagine none of this has happened yet. We're just looking from this price point to this price point, these couple of candles. And what we see is that price traded higher, taking out the liquidity all the way to the left, the high liquidity, and creating this swing high here. So the next thing is that price went into a bit of a consolidation, staying in this range right here, as mentioned before. Alright, and then we can see price had a wick lower, taking out this sell side, then a wick higher, taking this sell side before this bearish displacement. So let's actually look into the marketplace in the smaller time frames to see how that area of consolidation looked like. If you remember, on the daily it was just wicks taking out these sell side liquidities, but when we drop down we can see a much more finer point of action. So here we have our sell side liquidity of the area of accumulation, and here is our buy side liquidity, our area of accumulation again. And so price was to do what? Just make it the right colors. Buy stops, sell stops, and buy stops here. Price came, took out these sell stops for trading higher, taking out these buy stops. but price created an imbalance here, these gaps. So price is gonna retrace back down into these gaps before trading higher, taking out this swing high here, or taking out these swing highs here, taking out basically this area, because there's lots of liquidity above it as well, because it just took out this liquidity, but it made more swing highs, so there's more liquidity now. So price would trade higher again, taking out those liquidities after it filled this inefficiency here. So price did that exactly, took out this buy side liquidity before trading all the way lower with a strong move, taking out this swing low and this swing low, giving us our bearish shift in market structure. This is what we need to see to get our bearish shift in market structure. Then price was to trade back up to fill what? To fill these gaps here. Maybe on the daily you wouldn't find these gaps, but here you can see it's a bunch of gaps. And price went up before trading lower again, attacking this, which is what? A low resistance sell side liquidity. The market is just in routine. It has its own like set of plays. It goes in an algorithm. It goes step by step, one by one. But let's go down to the 1 hour actually. Let's see what more there is. So you might be wondering why price went to that exact point before trading lower. And what do we see on the 1 hourly? Boom. This right here. This beautiful black candle. What is this beautiful black candle? This black candle is an order block. Order block. That's what it is. So price came down to this hourly order block. Let me just make it dashed so we can identify it. Order block. And look, the bodies of the candle respected the high of this order block. So after that price was at this order block level, you can expect price to continue trading lower, targeting this low resistance sell side liquidity. And that's exactly what happened. So that's how you use the different time frames to analyze the market, to have a top-down analysis. Called top-down because you start from high and you go lower. That's why it's called top-down analysis, and this is the reason why we do it, because we see more stuff, we see more information, we see more data. But none of that is important if your initial analyzation on the daily and the 4 hour is incorrect. More importantly, the daily. You need to make sure what's going on in the daily makes sense. Like you're able to understand why the market is doing what it's doing on the daily before dropping down. And it's gonna take a lot of practice, but once you get it right, you got it right for life. It's in your head there forever. So that's how we use a top-down analysis, and I hope you understood it from a bullish perspective and a bearish perspective. Let's go back to the slides and see what's next. Our change in bias. This is very, very, very important, because eventually you need to know when there's going to be a change in bias, when you should switch it from going long to going short. And as I said earlier, our bias stays the same until we see a reason that it changed. And the main reason we get a change in bias is when a large pool of liquidity has been taken, or there has been a shift in market structure. And a bullish shift in market structure would be when the underlying bias is bullish. That means price has already taken out some sort of sell stops, and you can expect price to trade higher. That's the underlying bias. Means it's underlying. So after you've seen price take out that sell stop or to fill that inefficiency, what you'd want to see is a displacement taking out a key high, or taking out a key high. And that is price action indicating to us that market wants to reprice higher now. And the bearish shift in market structure is the opposite. So when the underlying bias is bearish and there's a bearish displacement taking out a swing low or a key level, and that is price indicating to us that market wants to trade lower. You see what I mean when I say indicate? Like typically people would have their RSI, their MACD, all of this stuff to tell them whether the market is bullish or bearish. But using these concepts, you don't need those indicators, because those indicators are doing more harm than good. Let's say you have an RSI and MACD. RSI is saying that it's overbought, and MACD is saying that there's a bullish divergence. So what does that mean? MACD is telling you that price wants to go higher, But RSI is telling you that price is overbought and should be trading lower. You're stuck. One is telling you this and the other is telling you the opposite. But all of them are lies. They're just not lies completely, because there is actual logic behind it and how it works. But the main king is price action. If you can understand price action very, very good, you can become a profitable trader, and that's all you need. That's all you need to understand whether market is going higher or lower. It's just price action, man, and market structure. Next is an example of what a displacement giving us a shift in market structure would be. And this is how it looks. So first we see this initial higher displacement, where price has a little bit of a retracement before going higher, creating these sell side liquidity here. So price was to retrace below this sell side liquidity to fill these gaps. And this is something you typically see. You typically see a swing low, and below it are gaps. So what you'd expect to happen is price to trade lower, taking out the short-term sell-side liquidity and filling these gaps before trading higher, taking out this swing high, which is our low resistance buy-side liquidity. So once you see in price take it out, we get our, with a displacement, that's it. Market is bullish until we see it be bearish. Same thing happening here. Our initial price action going lower. Price trades higher, creates a swing low here, trades higher again, it fills the gaps. You see the bodies of the candles here all fill this gap and all are reacting to this bearish order block, just like that, before a displacement lower. So let me go real quick in the charts. No, actually before I do that, let me quickly explain to you guys what ranges are. And we use trading ranges to guide us in finding the optimal entries for our trade, and to find if a price is either overbought or oversold. So if you're looking for the bullish trading range, you would drag the fib from a swing low to a swing high and have only the 50% line marked out. That would be our equilibrium. And an equilibrium is basically balanced. It's in the middle. So from this swing high to this swing low, at this 50% line, that's our equilibrium. That's the midpoint from this swing to this swing. And if you're looking for the bearish trading range, you would drag the fib from a swing high to a swing low, having the 50% line marked out. Same old, same old. You have the body of the swing low here and the body of the swing high. And then you'll have the 50% marked out, which is our equilibrium. And yeah, that's basically how to find the range. And the importance of the range is that there's premium versus a discount. So when market is in a premium of the range, it's trading at a level that is considered too expensive for the market, meaning it should reprice lower if, very big if the underlying bias is bearish. Or when market is in a discount of the range, it's trading at a level that's considered too cheap because it's a discount, meaning it should trade lower if the market bias is bearish. No, there was a mistake here, excuse me. So when market's in a discount of the range, it's considered too cheap, right? So the market should trade higher. I don't know why it says lower. Made a mistake, so let me just change it real quick. Should trade higher. Okay, 1 second. So we'll know that we're in a premium when price is trading above the 50% level in a bearish trading range, while when price is in a discount, it's trading below the 50% level in a bullish trading range. So let's go on the charts and let me explain to you guys what the bullish shift in market structure and what the bearish shift in market structure is, and explaining the ranges at the same time. So we get our bearish shift in market structure here when price traded below this swing low with this strong displacement, and the underlying bias is already bearish because if you remember correctly, price took out this key swing here before offering prices lower quickly. This would be our swing low. So this gives us our underlying bias when price traded higher, taking out this buy side liquidity. Then price traded lower, creating this swing low here, before giving us this displacement lower. And this displacement lower is our bearish shift in market structure, because that's market telling us that it wants to reprice lower. So we'll drag our fib tool from the body of the candle to the body of the candle. And what do we see here? Typically, when price is in a downtrend, you'd expect a retracement to above the 50% level before trading lower. So you see here, this is our range. See, from this body to this body, right? Or no, let's see from here to here. From this body of the candle, this is the highest body, to this body here, which is the lowest body. You drag it from here to here, and that gives you your trading range for this couple of days, for this 6 days or 4 days. And then once we and so already I need you guys to understand that the market bias is bearish. Let me just put that out there. Market bias is bearish, right? And the reason is because price traded below that swing point with a strong bearish candle, a displacement. That's what a strong bearish candle is. Displacement. Alright. And then price trades up into where? The premium of the range. And the premium of the range is when we are bearish and we would drag from a swing high to a swing low. So we have our bearish trading range. This is what this is, a bearish trading range. You would expect price to retrace up into a premium. So price retraced back up into a premium before trading lower, taking out this swing low, which is our low resistance sell side liquidity. That's what the market's doing. Market's gonna have a displacement lower, retrace up back into a premium before trading lower, taking out our low resistance sell side liquidity. So that's what the premium of the range is when we're in a bearish range, in a bearish conditions. And then now let's look for a bullish condition. Alright, so over here, what do we have? Price traded higher with this displacement over here, and then we'll see the range from this candle to this candle. We'll see same thing. Price traded higher, so this is our range from this swing to this swing. Then price came, and our underlying bias is already bullish because price traded with a displacement, right? Taking this swing high and taking this swing high. Price took it already, so that's it. Our market bias is still bearish. So we have all of this bearish bullishness here, sorry. And then once price, we've seen price trade above this swing high and taking out these swing highs, our bullishness is still intact. We're still bullish. There's no signs that we have went bearish. So price was to trade up higher to this top, making a swing high. So that's our top of our range. It's our bottom of our range. Price went down to where? To our discount of the range. Discount, because it's below the 50% equilibrium line. That's all it is. When we're expecting price to be bullish, you drag a range from the swing low to the swing high and see price come to a discount before trading higher, targeting the low resistance buy side liquidity. Let me write that down for you guys. And it's very important that you guys have been taking notes during the course of this video. All the videos actually. So when market bias is bullish, we would get our bullish trading range. We would get our bullish trading range from a swing low to a swing high. Once we see that swing high, we would expect price to make a retracement lower into the discount of the range before trading higher, attacking the low resistance buy side liquidity. And the opposite for when the market bias is bearish. So when the market is bearish, we would get our bearish trading range from a swing high to a swing low. Once we see that swing low, we can expect price to have a retracement higher into the premium of the range before price trades lower, attacking the low resistance sell side liquidity. Resistance SSL. So I hope there was a lot of information covered actually in this video, and I hope you guys understood everything that was explained. And if not, because this is not something that you can learn just watching one video or writing a couple of notes, it might, like you personally, it depends. Every person is different, you know. Not one guy is the same as the other. So maybe for someone you can understand this in just one sitting, but for some other people they might need to watch this video 2 or 3 times before fully grasping the concept. And trust me, there's nothing wrong with that. The more you watch, the more you learn, and the more you learn, the greater you're gonna benefit. And that's what this is all about, just becoming better in trading and becoming better in understanding these concepts. That should be your main and primary focus. And that's the end of this video. So take care guys, and see you later.